Hey everyone, it's Ben here, and today we're going to be going over a Microsoft DCF. And I've done a Microsoft DCF in the past, actually, and let me just pull it up real quick. This kind of gives away a bit of what we're going to do. But interestingly, the reason I'm bringing this up is because in our base case scenario here, it implied that the share price would be $379.32 when the current share price at the time back in July 26, 2022 was $250.82, implied 51% upside. Interestingly enough, when we look at Microsoft stock today, it's currently at $374, so pretty close to what our base case scenario was in that previous DCF. Now, a lot has changed. When I did the DCF last year, AI was not really a thing, or it was, but not to most people. You know, ChatGPT took the world by storm and everything. And it's really changed the company quite a bit. And we're going to do our best to kind of reflect that in the model, but there are some limitations to that, which I'll discuss later. And if we just take a quick look at Microsoft stock, you can just see that over the past year, it's just been on the up and up. And actually just throughout its whole lifetime, if you go back, it's just been on the up and up. But what's interesting about Microsoft is that obviously it was founded by Bill Gates, and then the company did super, super well as just like primarily focused on software. And then a new CEO came, and Microsoft is kind of seen as like this big conglomerate, like slow company. And then the new CEO, Satya Nadella, he made a ton of like really big acquisitions and has really like shaped the company strategy really well, making it now the second largest company in the world by market cap. And I'll go through some of the comps right now in a bit, but basically even as such a large company, the growth that it has is pretty crazy. We'll go through that in the trading comp section. But kind of continuing on in our situation overview for the company, the bull case. So as cloud adoption accelerates and Azure, if it continues being a convincing winner in comparison to its big competitors like Amazon's AWS, Google Cloud, that'll be a huge bull case scenario for the company. And then I'll go into a little bit more detail about that. But the second, if operational efficiencies continue to carry along and margins keep increasing, then that will be another bull case. And third, AI leadership. Microsoft invested, I believe they own something around 49%, if not, I think it's 49% of OpenAI. I think they invested around $10 billion. And everyone is talking about how AI is the future for everything. For a lot of Microsoft's products that are using AI to kind of boost the productivity in a lot of their tools, they're powered by like ChatGPT, OpenAI. And so we'll see how things go, with the AI and the company in the future. It'll be interesting to see. I think no one really knows where things are going, and we're really, really in the early inning stages, just like the internet back in the 90s and early 2000s, I think. Bear case, weak macro impacting IT spending, potential recession issues. That's kind of true for all companies, but it's still definitely a bear case scenario for Microsoft. Second, increased investments could hurt margin expansion. So I think I remember last time when we built the Microsoft DCF, there was a lot of spend on capital expenditures, and you could be spending all that money when you have growth, but then as soon as things start to kind of like pull back, then, all of that investment may not really have been worth it. Third, AI adoption, if it's limited and there's further issues with OpenAI, then that could also be an issue. There's increasingly more and more agile competition. OpenAI is already getting really, really big. So if ChatGPT, OpenAI, whatever Microsoft is kind of like backing or using, doesn't maintain the lead, then that could be a huge bear case scenario as well. So I wanted to actually go through some equity research reports and highlight a few key things that I thought were pretty interesting. So one here in Microsoft's recent quarter, the company generated 3% of year over year Azure growth from AI. And a lot of I think what's interesting is a lot of the partnership between Microsoft and OpenAI, like this, there's some interesting synergy because in order for OpenAI to process all the information that it's using to power its model and all the algorithms, basically, it needs to store everything in the cloud. And as a partner of Microsoft, basically Azure is kind of hosting, I think, a majority of that information / data. And ChatGPT is also powering several Microsoft Copilot either in development or recently launched, including Microsoft 365 Copilot and Windows Copilot. So Copilot, I haven't used it. I don't even know if it's out, actually. I think a beta version or something like that is, but it's basically for PowerPoint, Excel, things like that. You can use AI to just make your work a lot more efficient. And ChatGPT is behind a lot of that technology. So I thought that was pretty interesting. Another one here. So obviously recently, or you probably have heard that Sam Altman was kicked out of OpenAI and then he came back. So it's interesting to think about, how do equity research analysts and investors think about what happened and all that drama? And what the belief right now is that the outcome was a net positive for Microsoft. And that's because there's better alignment between OpenAI and Microsoft's goals. And the period of disruption was really short. Everything, he got fired and then he came back within like a week, I believe. So didn't really disrupt too much, although it did cause a big scare, I'm guessing, to people at Microsoft. Next, Microsoft confirmed that its OpenAI agreement includes perpetual access rights to all of OpenAI's IP and tech. It would need to continue offering access to its current large language model suite. That I thought was also really interesting. So basically, Microsoft has access to all the OpenAI's tech. And so, I can't imagine that Microsoft would necessarily create its own because it has such it's like its own competitor to ChatGPT per se, but it does have access to a lot of the information needed to make tools, or who knows, maybe even make something that's competitive in the future. So, and then the last thing is Microsoft is obviously very dependent on OpenAI's models, and a potential shift in favor of smaller, open, and tuned models doesn't strike us as a favorable development for Microsoft's AI story. So again, kind of pointing at the fact that there's a lot of agile new companies coming along, and you never know if they might disrupt, everything that OpenAI has built, et cetera, et cetera. So those are some interesting facts that I found regarding the situation overview for Microsoft. Let's next go into trading comps. And this is something that I've only done for one previous stream, which was Google. And I didn't do it for Berkshire Hathaway because Berkshire Hathaway is just such a weird company. It's just has a lot of these random kind of unrelated parts. Microsoft, you could kind of say the same thing, but I still think it fits under a more clean umbrella of just tech overall. And there's a lot more we can kind of compare to. So we'll go through all the columns here, and let me zoom in a bit actually so you guys can see better. By the way, I'm doing this stream late at night. Right now it's 9 p.m. Eastern, or 9:30 p.m. Eastern, because this is the only time I could fit into my schedule this week. So normally I will probably try to do the streams somewhere around the morning times, but this one is going to be late for that reason. So if we look at some of so first of all, these are pretty much just the largest companies / tech companies in the world. And you can just see first right off the bat, Microsoft's second largest in the world. And its current share price, this column is kind of talking about the percentage of its 52-week high. So this is red if it's high, kind of just that's obviously a good thing for the company because it means that investors have a lot of belief in the company currently and its future prospects. but it's red in the just a sense that you want to be looking for companies that are off of its 52-week high, kind of, because that could indicate, doesn't always, but it could indicate that it's a little bit more of a bargain right now. But there's usually good reasons as to why it's not trading at the 52-week high, so keep that in mind. Next, we're basically, this whole section here is your operational metrics. And they're pretty basic ones. So revenue growth, you can see, this is what I was referring to a bit earlier. It's pretty crazy that Microsoft, even though it's the second largest company in the world, next year is projected to grow at 17%, which is pretty insane because, if you have $1 and you want to grow to $2, that's 100% growth. That's, very easy. If you want to grow 100 million to 200 million, that's hard. If you're trying to grow like 1 billion to 2 billion, that's even, that's exponentially even harder. So the fact that a company this large, and usually when you look at previous growth rates for revenue, it declines over time because of the law of large numbers. But Microsoft is actually projected to grow even more next year than it has in 2023. So that's just pretty insane. And it's projected to grow faster than pretty much every single top tech company except for NVIDIA and Tesla. Margins wise, you also sometimes see when companies are going quickly that their margins are not that great. And it could also just be a reflection of the company's business model. Like Amazon, there's a lot of different business components of Amazon, and its e-commerce makes it look like the company's a low margin business, but its AWS actually is a very high margin business. What's crazy about Microsoft is that with all the different divisions and business products it currently has a 50% EBITDA margin, which is pretty crazy. Profit margin similarly in line, 35%. So there's a lot to really like about the company. And yeah, margin, if you just look at the margins and the growth, it's pretty crazy that it's still basically just doing this well. Next, let's look at trading multiples. So typically what you want to see are companies that have high growth, good margins that are high, and low multiples, because that means that it's just by looking at these numbers, it's trading at a bargain, or it is a bargain, trading at a potential discount. So what these multiples mean, and I do have a video on trading comps down in the video description below in case you want to deeper dive into what trading comps are. But this basically is your enterprise value over EBIT, enterprise value over EBITDA, and then your price to earnings multiple. And this basically just signifies how much you're paying per dollar of the denominator unit. So for every dollar of EBIT earned, for Apple here, you're paying $27.10. For Microsoft, $29. Alphabet, 18.9. So basically, the lower this is, then the cheaper the company is trading at. You can see obviously Tesla is very high, and that's why a lot of times when people cover Tesla, they're like, the more fundamental investors say like, oh, the company is trading way too at crazy multiples. It's way too expensive, et cetera, et cetera. What you can see from Microsoft here is that, well, let me take a look. It's not cheap, but it's not super expensive either, right? Maybe actually if we deleted Tesla, yeah, it's a little bit more on the yellow side. Amazon's also kind of expensive. So obviously you can't just like delete these willy-nilly, but you do see that as you do that, some of the other companies, it does look like Microsoft is trading a little bit more on the expensive side, but having these outliers make it seem like the company might not be. Let's also look here. So I think what's interesting here is, so these are premium / discounts to historical multiples. So basically this is just kind of looking at, okay, for Microsoft's previous EBITDA multiples in the past, NTM is next 12 months EBITDA. So this is enterprise value divided by next 12 months EBITDA. In the past, is a company trading at a premium or a discount to historical multiples? So is it right now over the past like 1 year, is it more expensive or cheaper? And over the past 2 years, over the past 5 years, what it's saying right now is that Microsoft is trading at an 8% premium to what it has been trading at in terms of an EBITDA multiple over the past 1 year, 11% over the past 2 years, and 10% over the past 5 years. What you want to see is a company like NVIDIA where it's trading at 39% discount, 33% discount, 32% discount. Now, again, there are very, very good reasons why companies trade more expensively and are trading at discounts or premiums. And it's because of like where the company is headed in the future. So you can't just look at these numbers and be like, oh, I'm just going to pick a company with high growth, good margins, low multiples, and that'll be, a slam dunk investment. If it was that easy, then we'd all be rich, basically. So that's kind of an overview of trading multiples. I'm going to answer some questions, but let me know also if you have questions about what I went through. I know I didn't go into like extreme detail, but basically the punchline kind of is really good growth, really good margins, trading at a reasonable value, but not like super cheap. By the way, though, as companies grow more and more quickly, these multiples decrease at that rate, kind of. So if a company is growing its EBITDA growth or it's like revenue a lot more quickly, then its multiples will decrease much more quickly over time. So let's say if, right now we believe that Microsoft's EBITDA is going to be like 10 billion or something like that, but actually gets to 20 billion, then this multiple would decrease to something like 18 or whatever, right? So then these are just like projections based on street estimates. So I see a few messages in the chat. So I see one that says, thank you for making these videos. Used to prep for IB interviews. That's awesome to hear. And I hope IB recruiting went well for you. Gemini was just recently released by Google. Can you see this as increase in competitive atmosphere, therefore increase CapEx and R&D a little more? I don't have the granular detail to know how much more, but we will take a look at historicals and maybe street estimates to see if they're expecting to increase their CapEx. So that'll come as we build the model. And let's see if there's any other questions. I just added me on LinkedIn. We'll add you back. When forecasting our EBIT margins, would you exclude any historical negative margins if majority of historical years have positive margins? It's very odd to have like negative margins in the more recent years. It's more common to have negative margins in the way further back years because companies usually start unprofitable and then they start to get profitable. If you have a company that's going from like profitable to unprofitable to profitable to unprofitable, then that probably just means that it's still a startup, still in its early stage, and it's not a very profitable company. So to answer your question, I wouldn't exclude, I would kind of look at the trend and see where that's going in order to make my estimates. I wouldn't like exclude that as part of like what I think about when I make projections. Last question before I move on. What are my plans post MBA? I am going to keep working on Rare Liquid. I'm launching my how to get into MBA course actually next week. Fingers crossed that everything goes smoothly. But in the next, like, let's say 1 to 2 weeks, been working on it for like a year. So I'm super excited. I think it's going to be like a super, super great product. And so that's what I'm working on right now. When I graduate from MBA, I'm going to keep working on making that course better and better. I'm also working on a how to get into banking course and also a consulting one. So with classmates, by the way, who all worked at like top banks and McKinsey, Bain, BCG. And so working on all that will take like a lot of time. I also want to start or go back to just consistently making videos because as you'll see from my channel as of right now, I haven't posted many videos over the past 6 months or so. So I kind of want to get back to that as well. And I have a lot of plans. which I will update you guys on in future videos. So let's go back to our agenda here. So we just went through trading comps. Now I want to let you guys know about Wall Street Prep, the sponsor for today's video. And they have this course called the Buy-Side Financial Modeling course. And I'm actually planning to take this next summer after I graduate, because I think this is just going to be such a helpful course. And I can also let you guys know after I do take it, probably like second half of next year, you know, what I learned kind of, and like what's really in here, I guess. But it's taught by a hedge fund veteran, Brett Coffron, ex-Maverick, Citadel, D.E. Shaw, Schoenfeld. So just really a lot of top companies, and you'll learn a lot about various aspects of buy-side modeling, which is kind of different than what we're doing today. Like today, it's a little bit more investment banking oriented, a little bit more, today what we're doing is more high level. You can definitely get more in depth in banking as well. But when it comes to the buy side, you do oftentimes have to get even more granular and very, very focused on your key inputs. And so there's a lot of different aspects of the buy-side modeling process you'll learn, like process-driven investing, buy-side model construction, analyzing a business, forecasting, etc. And you can just see, like, if you go down in my, using the link down in my description, you can see like the course samples and everything. And then you can see, you know, there's just a very, very thorough course of a ton of different topics, and you can feel free to check it out. I also would recommend, if you want to basically take a step earlier, they have a financial and valuation modeling certification program, and this really teaches you everything that I learned in banking, like financial statement modeling, DCFs, M&A modeling, which is accretion dilution, trading comps, which we went through today, transaction comps, and LBOs. So you can check all that out. You can use my code RareLiquid to get 20% off of any of these courses. And so feel free to check them out. So with that, I do want to actually go through some reminders. So this model will be available for free to download after the stream ends. And you can look at the description later on in order to download this model. This is also a high-level DCF based on street estimates. It's not financial advice. And it is high level, but we're trying to basically just see, the point of the analysis is, given what the street thinks, how much more optimistic or how much more pessimistic do we need to be in order to invest in this company? And we'll have like a range in order to allow us to test for different scenarios. Then, or next, if you want to learn more about financial statements, Excel shortcuts, DCF tutorials, trading comps, I have those videos down in my description as well. You can also go to my live tab on my channel. I think YouTube tabs, I don't think are really utilized super well, so that's why I just kind of want to go through this. If you go to live here, then you can look at all the different DCFs that I have. And I think starting from this NVIDIA one is where you can download the model for free. So starting from now on, all the models are going to be free. All these other old ones, they're old and outdated anyway. So no need to really like check them out anyway. Okay. So what else am I missing? As I mentioned, working on a how to get into banking course. So you can sign up for that as well using my link in the description. And with that said, let's work on our DCF, and we're gonna, just like the Berkshire Hathaway video I made, we're gonna do a revenue and operation, actually OpEx. Are we gonna do? We might do an EBIT build. I'm gonna have to look at the information I have. Next, street-based. And then we're gonna be building out our street-based DCF, then go into WACC, mid-year convention, and then discuss the price based off of what our analysis shows us. So, and wow, okay, I'm surprised that there's 73 of you guys on this late at night. Let me know down in the comments where you guys are from, actually, like what city/country. Because right now I'm on the East Coast in the US, and you know, it's around 10 p.m. Okay, so let me zoom in here. Okay, so let me make this 3. I am going to build everything from scratch, but I do want to show you guys a little bit. Given that we have done the Microsoft DCF in the past, I think what I kind of want to show you guys is like when you're working at the desk at an investment bank, while you do oftentimes build things from scratch, you do take from other models, like copy paste in a bunch of stuff, and that just makes you a lot more efficient, right? I'm not gonna copy paste like everything from like previous models, but I do want to do that a little bit so that you can kind of see how to efficiently build things. And also, you're gonna have this model pretty soon to be able to download and follow along. So you can kind of copy paste from this model or previous models actually that I've that you can download for free. So one thing I'm gonna do is adjust the column widths to make them all the same size. Okay. So what I'm going to do is go into our Berkshire Hathaway DCF, and let me move this down. Okay, I don't know where the screen went. I'm going to drag it down. And I kind of had this a little bit of a new type of assumptions formatting. And I think it's going to be pretty relevant for Microsoft, the DCF we're building today. So I'm going to copy paste this. But obviously, a lot of this is going to be different. So I'm just going to delete a lot of this stuff. You can leave those numbers. We'll fill that out later. Delete a lot of this as well. Okay, so these will be our assumptions that we're going to kind of fill in a little bit later. So we'll have this pretty much good to go. And so basically, if you go to my Berkshire Hathaway live stream that I posted, I think a week and a half or so ago, you can download this model for free and basically just do what I did. Shift, spacebar, down arrow button multiple times, or you can just hold it down, control copy, and then go to your this place to your current file, shift, spacebar, and then control V. Okay, and then let's take a look a bit into Microsoft's segments so that we can start doing the revenue build. So what I wanted to look at, okay, so yeah, I wanted to see if we should do like an EBIT. It's not going to be an EBIT build because for Berkshire Hathaway, we did have information on where is it? The costs and expenses, all like the cost of goods sold and the operating expenses for each segment. For Microsoft right now, we just have the actual EBIT. So what I think I'll do is probably build sensitivities for the 3 segments for the EBIT and the revenue. So I'm going to change this not to revenue and EBIT build. I guess they're not build. So revenue build and EBIT scenarios or something like that. Okay, so we have this information here. What I'm going to do is go again to Berkshire Hathaway. We had a revenue build. I kind of like how this was structured and how it looks. So I'm going to copy this, go into our DCF and copy it. Paste it, I mean. Okay. Cool. So let's start out with the revenue build and kind of get things going. I'm going to rename this to DCF. And after I finish the revenue build, I'll answer questions in the chat. So feel free to ask away and I will get to those questions. So let's see. We can start from 2016, but there's like some weird things happening here. So I think if we do from 2018, then that provides 5 years, which I think is more than enough, or a good amount of data, a good amount of historical data. And by the way, Microsoft reports its earnings, or its fiscal year end is actually at the end of June. But I downloaded these as calendar year end for December, the end of December, because it's just cleaner that way and it helps for the DCF. So these numbers are probably going to be a little bit hard for you to find if you actually look for them, unless you have FactSet. So 2023 is almost over. And so what we want to do is kind of basically have like a 5-year DCF, or it'll be kind of like a 6-year, but essentially it'll be a 5-year DCF. So 1, 2, 3, 4, 5. Don't need this. Oops. Okay, I did it that way, by the way, because if I were to delete this, then it wouldn't have this border, and I just didn't want to make this border, or I don't want to have to remake that border. All right, so 2018, we're going to start, there's 3 segments for Microsoft: productivity and business processes, intelligent cloud, and more personal computing. So I'm going to just link to those, and then also add new rows because we need to add the 3rd segment. By the way, as I do this stuff that's a little bit more just, I guess, manual, and there isn't as much to explain, I'm going to be building out an LBO, aiming for this Friday. It could get delayed, but I know some of you guys have been asking for different types of models and stuff like that. And so I think it'll be a pretty good and interesting exercise. So hope you guys tune in for that. If you want to kind of keep track of, when I post all of these, like sometimes I announce my streams on my Instagram, which is just Rare Liquid. So feel free to follow that if you haven't, or if you're not following already. And I also actually recently started working on MBA related and consulting related memes. So we have meme accounts, and you'll find them in my Rare Liquid bio. So I'm working on on those with MBA classmates, and they're pretty funny. So feel free to check that out as well. So right now what I'm doing is I'm just simply collecting the historicals, and then we're going to try to look at some trends. I guess it would be nice to have 5 years of historical data. So I'm actually going to add 2017 here. Okay. So now we can just kind of take a look at what is happening over these past 5 years. And actually, now that I think about it, we do have estimates as well. So we can look at what the estimates are saying. What I'm thinking about right now, okay, so one thing I'm gonna need to do over here on the bottom, actually it's not that clean to do it here. For this revenue build, I think what I want to do is actually, there's like street estimates that we want to consider. We don't want to just be looking at historicals. So I'm thinking about if I should add a completely new section for estimates. Okay, won't take that long, so let's just do it. My computer is a little bit laggy when I stream. I think I need to buy like a normal desktop computer because right now I use a laptop to stream these videos. Okay, so let's do income statement. So this is gonna actually mess a few things up. So I'm gonna build things out up here just like to reference. You guys will kind of see why I'm doing this. In a bit. Okay, the reason I did that is because we can actually just copy paste these and there are estimates, right? Okay, so let's see what this is saying. Okay, so you can see that for this first segment here, at least based on what the street thinks. Okay, so first thing to explain, like the reason the numbers are not always reliable is because the number of analysts drop off after a certain number of years. So I'll show you what that looks like. So if you go to Microsoft, something like right now we're looking what we're looking at, productivity and business. You can see that for 2023 or June 2024, which is their end of fiscal year, you can see that there's, I don't know, like 20, 25, or it looks like 24 brokers. Then 2025, there's also 24. 2026, it drops to 10. So that would mean that it would be 2020, the year of 2025 that's affected. So starting in year 2025, these numbers are not super reliable. And you can kind of see that in this because you have revenue growth increasing this year, next year in 2024, then it's decreasing, then it's increasing by 5%, which is a ton. So that's kind of weird. Intelligent cloud increasing, but I don't know, kind of increasing by like huge amounts in these later years. Also, arguably a little bit weird. And then little bit similar scenario here. Like why would it decrease by 8% and then go up to 10%, right? And then you can also, if you remember, for 2022 to 2023, if we looked at our comps, Microsoft, we said that it would grow by around 10% and then 17% in 2023 to 24, right? And that is a little, and it says 11% and 14% here. So the reason that these numbers are a bit off is because we are adding figures for like individual estimates for different revenue segments instead of the overall whole revenue estimate, which would be a little different. So basically, if we were to go to all estimates here, I believe, so if we look at 22,272,274, if the numbers are correct, then this should be, all right, 260,464. Okay, I guess it's 15%. So that actually makes me wonder why this is saying 17%. So this is 45. $260 and 223. Okay. So this must be like 16 point something percent. Yeah, 16.5. So it's barely 17%. And this probably is like 15.3 or 4 something. Oh, 14.6. Okay. So I'll probably look into this, but basically I don't think let's see. I don't think the growth rate is closer to 70%. I think this like 14.6% is probably a bit more accurate, basically is what I think. And that's close to this 14% that we have here, right? But we're going to look at these figures and then not necessarily use too much of the 2025 to 2027 figures. Okay. Cool. So now I'm going to have to kind of relink to a lot of this stuff. Oops. Okay, so I'm going to link back to what's up here. And I know this probably seems crazy as to like why I'm doing this if you haven't seen this before, but it'll make sense in a bit. By the way, this color coding, when you link to numbers that are in the same sheet, then at least for JP Morgan, what we did is we linked, we made those purple. Green means you're linking to a sheet, a different sheet in the same Excel. Black means that you're calculating something, and red means there's something weird going on, and we'll probably use like all those colors at some point in this model. All right. So the reason that I did this is because I do want to use some of the information that the street provides and estimates, but I don't want to, like, I didn't want to like build out all we did in here, because usually for your historical data or just like your information that you're linking to, you want to leave that just as is. And you want to make all your kind of like adjustments to the data and like analysis on a separate page or a separate sheet. So that's why I built that up here. I wanted to kind of show you guys best practice instead of taking like a bit of a shortcut. And now what we want to do is kind of look at the trends, see what also the street projects, and then build out our own cases. So starting off with productivity and business processes, we can see that it's, you know, it's been around 15-ish% or so, but it's kind of a little bit more on a decline. You can see that in 2023, and where there's only 1 month left, or, you know, actually less than that, like 17 days left in December. So that means that this number is going to be pretty accurate, because equity research analysts are talking to management all the time and constantly updating their models. So we're going to kind of go with what is in here for 2023. 2024 as well, the analysts do tend to be a little bit more accurate, and there's a lot more because that are forecasting just for 1 year or to the next year, versus like 2025 onwards, there's less and less. So usually for 1 year looking out, the analysts don't tend to be too far off either. For whatever reason, it seems like they believe that growth has slowed in 2023, perhaps because of the potential recession, a lot of layoffs, etc. But maybe with the new partnership with OpenAI and how things have been developing, maybe they believe that's like a reason why this segment can go higher in the next year instead of decelerating. Okay, so I'm going to make this purple because I'm linking again to cells within the same sheet. And then it's a matter of what do we do for these latter years, right? And I think what I would like, what the street believes is that based on these, you know, wonky numbers that we have here, it's going to go from 12 to 11 to 16 to 16%. And historically, it's been around 13 to 15-ish% or so, 13 to 17% actually. But as the segment grows larger and larger, it becomes harder and harder to continue growing, right? So I would say what probably makes sense here as a base case scenario, in order to like not be overly optimistic, I kind of actually want to keep it pretty flat. Like I don't want it flat from 2024, right? And I think normally I actually, if you have been following my models, I do like to actually decrease over time, or decrease over time. But in our scenario here, you know, I think it's pretty fair to think that it'll be around 12%, and there might be years where it's below that. Might be years when it's a little bit higher. But as you keep growing at 12%, it gets harder and harder to grow at 12%, right? So this is, I don't normally do this. Actually, I don't even know if I want to do that right now. Like if you were to look at, and I'm thinking out loud here, by the way. So what you guys are listening to is like a process, not really like someone who has a definitive answer right away. But I'm looking at these historical figures, and you might think when the company was at 33 billion in revenue for this line, or 43 billion, that it would stop growing at like 16, 14, 15%, that maybe it'll drop down to, you know, drop this 16% down to 13% over time. But instead it went from 16 to 14 to 15, 17, 13, right? Now it's down to 10, next year 12. But there's basically what I'm kind of thinking about is that there's no reason why this can't necessarily continue a bit. And maybe potentially in some of the years, not all, go to somewhere around like 14%. So that's why I'm kind of like leaning towards actually just keeping things flat at around 12%. I think that's a little bit more conservative than what these estimates provide, but again, these are not very reliable. And I think it does account for some of the increase and some of the potential decrease. So I'm actually going to just keep this flat, which I don't normally do. Okay. So yeah, interesting. Yeah, I guess that's what we'll do there. For 2023, I'm going to keep it for even for our conservative case and our optimistic case. I'm going to actually just keep it the same as our street estimate. And that's because, again, we only have like 17 days left. I don't think this is really going to vary that much. Then for our conservative case, this is where we're going to need to start making some changes. So, okay, so the first thing that we're going to be looking at is for our productivity and business processes. 2024. Yeah, 2024. For now, let's say that they're off by 90. It would be off by. We're going to take 90% of the base case, and then for our optimistic case. Oops. We'll do 110%. And I think that probably will be possible, like either scenario, just because so much has been, every year, so many crazy things happen. Being off by this much, I think, is within the realm of possibility on either side. And we do want a conservative case to be pretty conservative, and this is where I'm going to actually be growing it down. So let me see how I did this for the Hathaway video. Okay. So for the year 2028, let's grow it down to 9%. I think that would be that's somewhat conservative, I believe. And then for optimistic scenario, let's grow it up. Actually, no, growing it. It's at 13% over time. I think that's already pretty optimistic. Let's grow it down to it's not going to be much, but let's just say 11.5%. And we can always adjust these a little bit. You can also adjust these a little bit as you see fit once you have the model and want to play around with everything. So if you don't agree with anything I'm doing, everything is adjustable. Okay, I did want to check this. We do want our optimistic case to be, obviously more optimistic than our base case. So I actually think we may be a little bit too, or 11.5 might be too pessimistic. It's not going to be much, but let's just make this 12.5% then. So that, the minus that, divide by that should work. I'm going to change this so that I can copy paste this down. Let me remember how to do this. Actually, we are not copy pasting it. So this is currently 13.5, and then we're growing it down. Actually, we are. So let's see. This, we want to anchor our column, F4, and then that should be fine. So maybe this should work. Yep. Cool. So we're gonna, I just made this switch for our productivity and revenue processes. So let's use our offset function. So we reference the cell we're in, then we go to our switch, which is up here. Press F4 to lock it, 0, because we don't need to reference our columns. And then get our previous year times 1 plus our growth rate. Make this black font because we are calculating. And now we have our first revenue segments revenue. So compared to our street, you can see that we are a little bit, this is in our base case scenario, we are a little bit more optimistic in 2025 and less so in 2026 and 27. And I think that's okay. I do think these like 16% growth rates are probably a little bit on the too optimistic side and probably are not correct. I think staying up flat around 12%, pretty fair. But I would probably argue, yeah, I guess any of these scenarios are kind of likely of happening. So I would stick with the base case for this one. Okay, next is intelligent growth. What was we gonna do here? So again, probably do a similar thing. For our first year. And let's take a look at the trends so far. So 19 to 25% or so, a decrease, and then a slight increase over time. So as you can see for these like estimates, it's almost like kind of unhelpful to look at them because they kind of anchor your thoughts into thinking like, oh, maybe we should be more optimistic. But I think it's just that whatever analysts are left here, they are just the ones remaining are the optimistic ones. So just keep that in mind. Okay, so drop in 2023 to 17%, increase to 18% in 2024. So we're gonna for our base case scenario, we're gonna keep what the street believes. Let's see. Yeah, I think it can be similar to what we did for our productivity and business processes. I think we can do the similar thing for our intelligent cloud. So cloud is basically like Azure, and it's one of Microsoft's like key growth drivers. Okay, so I think 90% for 2024, 110%. This should be okay. Cool. So let's think about where and how to kind of like grow or decrease these in the future. So you can see this was actually the highest growing segment of Microsoft over the past 5 years. And it's starting to slow slightly. I think in the base case scenario, we don't want to decrease it that much because historically this has continued to be like a very high growing business for the company, and I think it will continue to be. So, oops. I actually kind of tempted to keep this flat as well, or grow it down very, very slowly. Because I do think that there's still a lot of growth left for the cloud business. I feel like maybe 18%. Like you just never know, I guess. I'm thinking you never know if a segment actually will kind of slow down, but because like these past 5 years, you might have thought that it would have slowed down, but it didn't. So keeping it at 18% may actually be very like too conservative. I guess, yeah, we just don't know. I think what I want to do here is just grow. I'm going to make it so that we can adjust it a bit later, but I'm just going to grow it down. Basically, I'm going to essentially be keeping it flat, but I'm just going to grow it down to like 17%. But I'm going to add in the flexibility so that if we want to change it later, we can change it. So intelligent cloud. Intelligent cloud going to grow down to 17%. 2028, we will grow it down to 14%. And then an optimistic scenario, say that it actually will, not going to grow. Yeah, let's have it grow 19%. So I might adjust these numbers, but let's just link to everything for now. So this is going down to 14%. This is going down to 17. This is going down to 19. What we should be able to do is just copy paste this, and this formula should work. So that saves us time. So let's look at this trend. Optimistic scenario grows to 20%, which is kind of like what it seems like it's doable to bounce back to that rate, and then grow down to 19%. Kind of maintaining pretty solid double-digit growth for a while. I think in an optimistic scenario, this is possible. Although maybe I'd say this is like slightly it is an optimistic scenario, right? 17%, 18. I think Microsoft would be okay with this, but it's still like not like the greatest scenario. And then down to 14%, I think would be like a considerable slowdown. So I think that makes sense to me. Okay, so then let's go to our switch. See, there's a lot of activity in the chat, and I promise I'll get to some questions and stuff. Just need to finish this revenue build. We're kind of almost there. Our previous year times 1 plus growth rate. All right, now more personal computing. This one I actually do think is going to be fairly tricky because the numbers are pretty wonky. So I think, yeah, so if you look at this, it goes from like 7 to 10% growth, 11% growth, down to 0, then to 2%, then 10%, right? So I think for 2024, again, because it is just only one more year, I think the street is going to be pretty accurate with it. So we're just going to follow a similar process here. So times 90%. Oops. All right. Then the tricky thing is, you know, what is it going to look like in the future? Roughly speaking, estimates say around like 10%. But again, going from 10 to 8 to 10 is weird. It could happen, but don't think it's super, super likely. I think growing this down to something like 7% or 7 or 8% would be pretty fair given like these figures here. And then, so let's say we slow down the growth to 7% for 2028. And then in our conservative case, let's call it 5%, and optimistic case, 9%. So there's our conservative case. Here's our base case. And then here's our optimistic case. Again, we can copy paste this. Efficient. And then have our switch. So offset, reference the cell you're in. As I'm kind of doing this, and I know this is a little bit repetitive, just as a friendly reminder, this model will be downloadable for free after this stream ends. But it takes a little bit of time to get it processed and everything. So it'll probably be available not right after, but tomorrow. Okay, so then that, we can just actually copy paste this formula. So let's see, it's 2%, 9%, going down to 5%, 10% down to 7%, 11% to 9%. Okay, I think these make sense. Actually, maybe a little bit on the optimistic side, because there are some years that's like 0 or 2%, and so you do want to take into account those kind of bumps in the road. So I'm gonna decrease each of these by a percentage point. Cool. So now we have our very high level revenue build. Okay. Now I just need to add up the revenues. Cool. So let's see where this leaves us. It shows then that Microsoft will grow at around 11%, then 14%, which is similar and kind of in line with what we saw for the comps. Then basically the company will continue growing 14%, 14, 13, 13%. So not a huge slowdown of growth. I would say that this may be a little bit a tad onto the optimistic side. But, you know, also you might argue that the company is super well positioned in terms of AI, and there could be huge upside potential as well. So I think this base case scenario I feel like okay with. So now before we move on to operation or EBIT, let me go through some of the questions. Where should I start? There seems to be some conversation amongst yourselves as well. So let me just find a question. How are we able to split into different segments for products? Reminds me of some of the parts DCF. I would say to build a sum of the parts DCF, you need a lot of detailed data that a lot of times you won't have from just having, you know, what's available online or FactSet. To get product segment data, you just need to have like a good database for it. FactSet, for example, is what I'm using here. If you want to build a sum of the parts DCF for a company like Microsoft, I think that would be ideal actually. And it's also ideal to just go into way more detail than, you know, this, again, like I talk about this all the time, but these DCFs are very high level based on the street. And we're just getting to ranges to kind of see what we need to kind of believe in order to see if the stock is undervalued or overvalued. And if you were actually working at, let's say, a hedge fund or something like that, then what you're really most likely going to be doing is very detailed, like quarter by quarter analysis, and having very specific drivers of various segments that go into each of these three segments. So these three segments could be broken down into probably like, I don't know, at least 10 additional lines of revenue that each have based on like product or service. And each of those have their own drivers of like growth rates and all that. And you would use a lot of like different sources of information in order to come up with your assumptions for each line. And a lot of times hedge funds, the analysts and the portfolio directors, they'll have direct access to management. So they'll sometimes even go to meetings and be like, hey, what do you think is going to happen this quarter? And you won't always get like a straight answer from based on what my friends say, but you can kind of like get some hints. And in that way, yeah, hedge fund investors oftentimes have access to way more data than retail investors ever will. But they do face like their own challenges as well because they have so much money to deploy. So, what was the question I was answering was, to some other parts DCF, you're gonna also for each segment, you're ideally gonna want to have cash flow items for it. So like the DNA, CapEx, and net change in net working capital for each segment. And that's usually like not that easy to find. And companies don't break out those line items by segment. But if you did have access or just had found a way to make those assumptions for each segment, then you could build a mini DCF for each segment and then add up the enterprise values you get, adding up all the different DCF from the different DCFs, adding them all up, and then doing the sum of parts DCF. So anyway, that's hopefully answers your question. I'm not sure if I did, to be honest. It also is getting a bit late, so I'm like not as fresh as when I stream these in the morning. I see another question though from Aiden. Hey Ben, how did you develop the format of your DCFs? Was it a template type format you got from JP Morgan when you started in banking? For the most part, actually, there are certain things here that I would say actually the template that or if you've been following these models, like a lot of the DCFs kind of look like this. Although I added these like new, some of this like stuff is a bit new with like the last stream. But the models I built at JP Morgan actually, they look somewhat like this, but then I would say that a lot of times I would have a separate tab for the assumptions, and then there would be like way more assumptions, especially for the biotech models I used to build. And then when we were doing like actual revenue builds for the biotech companies, we would start off with like populations of the US, because usually there were US drugs. Then we would get to the number of people that are affected, or total addressable population, number of people who are likely to take a certain drug that for that company that we're valuing, the price for that drug that people would pay, and then we would also grow or grow the price as well year by year. And then we would get the total number of people who would purchase it, the frequency per year, and then multiply by price to get the revenue. And that would just be for one drug. And we would have like different assumptions or scenarios for each one of those lines that I just mentioned, with different growth rates. And that would be backed by data that we would get from industry research reports, which cost tons of money. But when you work at a big bank, you can just get all of that constantly. You could just download $1,000 report about like biotech or like the healthcare industry, and just grab like that could just be the backup for your assumption. So then we would do that for one drug. Also then have things like your probability of success. And yeah, I'm just thinking back of what I did, but imagine doing that and doing that for multiple drugs, and then adding all that together, and also adding like a patent cliff, which after a certain number of years, your drug is loses the patent, and then generics are able to be produced. And then so after that patent expires, your revenue just really declines very, very heavily, sometimes like, no kidding, 50 to 90%. So you have to build all that out. And then a lot of times our revenue growth rates weren't just like linear as what we're doing now. It'd be more just, it would a lot of times be like some kind of exponential curve. So then, you know, you have all these different scenarios. And so it's not really like what we have here is pretty simple. So for that reason, a lot of times in entirely separate tab, we would just only have assumptions. And then you could just change the assumptions on that tab and then see how that affects your valuation. So the formatting, I would say it would kind of look like this, but I would say also just like there were a lot more sections and parts to the actual models that I used to build. The reason I don't do it now is because I don't have access to all that research that I used to have, right? And so then I tried actually doing a very detailed revenue build for Tesla before on a stream, and then it was just like so convoluted, and there were so many me guessing a lot of things. Like we could guess trends for the next 5 years based on 5 years of historicals and street estimates, and it's like, okay, these are like somewhat reasonable within the realm of possibility, but then to do like true revenue builds, you need to have like a lot of really granular data. Okay. So seems like there's conversation amongst your guys or yourselves now. So I'm going to keep moving. EBIT scenario. So let's see if I'm going to build out EBIT. So we could sensitize. Okay, first of all, let's actually gather the information. Put it here. So we have income statement. All right. This is all revenue. Okay, so what I'm doing is I'm going to link to our EBIT and see if it's worth sensitizing. So we have our revenue, and then we'll have our EBIT here. Cool. So let's link 2018. So I'm going to copy paste the formatting because it's going to be the same thing. So something's happening with the font size. It's weird. It's 11 sized. Okay. I wonder what font size I've been using this whole time because it's inconsistent. Let's use 10. Okay, so sorry, I've been silent for a bit. Kind of been Just trying to get this all sorted. So percent of sales, get our EBIT, divide by our sales for that segment. Okay, so I wanted to, all right, first of all, why is this ending in 2026? Did I do this? Okay, I think I linked to the wrong year. This one might be to 2019. 2018. That's right. This is also, this is weird. Huh. That's not good. Wait, what happened here? Uh-oh. Okay, so I had my years wrong. What does this mean? Okay, so which means I started projecting. Oh, sorry. Okay. No, I had my years right. What happened is this is actually 2017. Ooh, okay. That could have been bad. So this should link to 20. Oops. Okay, I'm just going to double check everything now. All right, this links to 2017, goes to 2027. That's right. This should go to 2017, but it goes to 2018 probably. Okay, yep. That's why this needs to be moved. And then copy this here. Okay. Cool. So I did all that to basically see if there's a lot of variability and see if we should make our EBIT or sensitize on it. We can kind of see that compared to our revenue growth, our EBIT margins, let's see, so have increased for productivity and business processes and likely to potentially increase over time. Intelligent Cloud also has increased. It seems like it'll roughly stay kind of flat and around where it's been over the past 3 years. More personal computing is also pretty even. Okay. So yeah, I said I would build it, so I guess, let's just build it. Revenue and EBIT it does take the longest to build out. And then after that, the rest of the DCF is pretty easy. So just got to power through this last part and then we'll be good to go. So then this is percent of sales. Oops. Okay, wait. Is it worth it? So let's see. It's a percent of sales of for EBIT is like 42, 43, 44, 43, 43. So doesn't seem like it's going to really change much over time. Actually, don't think it's worth it. It would be worth it if you wanted more flexibility in the model. And I think actually if you want to take this step, take this to the next step without me walking you through everything, you can kind of do what I did for this revenue build, but do it for EBIT and build out different scenarios for each EBIT, for each segment. And, build out these different assumptions that you have here, add the switches and all that with like an EBIT section. But you won't have an answer key. And you can, but that can be your little assignment, I guess. But I will also put it to the chat. Like if you guys really want me to build out the EBIT sensitivity section and all that, let me know in the chat right now and I will do it. But if you guys don't care about it that much, we can kind of move things along more quickly and I can do the rest of the DCF. And for now, though, I will answer some of the questions I see here in the chat. So most important skills to learn in investment banking. Most important to learn in investment banking, like when you're actually in the on the job, I would say financial modeling is a big one. Just managing your mentality is also a really big one. I think that is not always stated. Like people always talk about, I guess it's implicit in a bit because of like the work-life balance. And then, so with, working a lot of like crazy hours, like, and potentially missing trips or like friends' birthdays or random dinners, all of that stuff, you got to like get used to that in a sense and manage your own happiness as much as you can in that kind of environment where you're working a lot. And so that I think has stuck with me for quite a while. And I'm always able to think back whenever I'm working on anything to compare it to banking and think sometimes like, honestly, at least it's not as bad, quote unquote, as when I was in banking. And I say that with a bit of a caveat. I want to add a caveat because if I were to go back in time and if I could change my career, I would still go into banking. I think that was super valuable for me. And I think after, first 2 years out of college, it was worth it for me to work really hard and put in a lot of hours, get a lot of reps in, maybe not spend as much time with my friends those early years, but I think Monday through Thursday, I don't know if I would have seen my friends that much anyway. And then Friday, Saturday, Sunday, I still had a good amount of time to like hang out with my friends. You just make time. So yeah, that's how I would answer that question. What else is here? Do you think forecasting revenue by segment is always necessary? I think when you are working with a client, then probably you will want to get more. It's better to get granular if you have the research and information to kind of back up your assumptions. The less data and research you have, the higher level you want things to be. That's how I would answer that. See a few people here. Oh, so could you add some layout for the keyboard so that it would show which keys are being used? Yes, I will look into that. I have been meaning to actually, but I haven't gotten to it. Okay, just took my corporate finance and thankfully this is all relevant. Okay, I see two people who want me to build out the EBIT thing. So, okay, I will just build it out. And then, okay, so what do we have here? To make things move along quickly for this part, since it will kind of look the same anyway, I'm going to copy this. Paste this. This will call our this will just be like our EBIT. It's not an EBIT build because they're not building it. Actually, in a sense, we kind of are. So we will, because we do have the 3 segments. Okay, why did these get all weird? This is percentage of sales. All right. So this stuff should be pretty self-explanatory. I should be able to also copy paste this. Oops. Actually, I don't know if that's right. Yeah, I don't think this is right. Okay, as I'm kind of silent as I do this because I'm just going through this, but I'm curious to know if you guys have watched previous streams for these DCFs. What was the first one that you watched? Let me know in the chat. Basically, which company was it? Or maybe this is your first one. Let me know if it's your first one. All right, so we're going to do a similar thing to what we did with revenue. But I think based on what I've seen, the margins should be a little bit easier because actually might be similar, but they seem a lot just more stable. So I just don't think there's going to be as many like questions that need to be posed as we do this. Oops. Again, I think for these 2 years, it's safe to assume that it's going to be pretty in line with the street. It's interesting that we see here, and for 2023, we're going to just keep it the same year, same percentage. I think it's interesting that 57% margins is like pretty high. And in the future years, I think it seems like it's going to stay relatively flat. Or it seems like it'll be maintained kind of at this level. I can't imagine it's going to go that much higher. Margin, so revenue, when I said that I normally don't keep things flat, like, I think it's the first time out of the 20 plus streams where I've kept revenue flat, I believe. Margins, on the other hand, it is actually when a company is at its kind of more mature phase, it is a little bit more common to keep things more flat. Like, it's not always that you do that, but I think it's little bit more understandable. Just as how you might keep your D&A percentage of sales, CapEx percentage of sales like relatively flat. So I think it's not going to get like that much higher than 57%. I think our base case scenario, I think Microsoft would be very happy keeping things keeping this business segment at a 57% EBIT margin. In our conservative case, instead of like changing just 2024 and 2025, I think we can just do like 95% of this, and then optimistic case something like 105%. I think that would be okay. So I'm going to name this EBIT, move it up. So this was for productivity and business processes. Later, we're going to need it for intelligent cloud as well. So this is for 2024 to 28. And by the way, I've never actually built my assumptions when I was at JPM like this. I never had something called metric. I've never had something for 2024 to 2028. This really is a bit just because I'm building like a high level model. And I think, yeah, when you build a model, there is no one way to build anything. So you can kind of do whatever makes sense for whatever you're building. And the reason I point that out is because to call something metric, or like this column to have it say metric, it's very confusing, right? Like it's 90%, 9%, 90%, 14%. And this is like 90% of 2024. And this is like the end of, or the year of 2028. What is our revenue growth rate? So in a JPM, like I think I would make things a lot more clear by probably having a section for like revenue growth, and then having like the different assumptions, and then having one for like end of year growth rate or something like that, or like haircut. I think the way it is right now is, would be a little bit confusing to audit. Oh, 54%. This is a pretty big haircut. Then that would also mean actually this 105% would be pretty high and overly optimistic. Pure is lagging. Okay. Yeah, 60%, pretty high. I would say that's way too high. Is it in the realm of possibility? I'm going to actually make this 97.5. So 2.5% reduction, and then 102.5. So 56, 57, 58. I feel like that variation's not really enough. Let's call this 97. So basically 3% reduction, 103% increase. Okay, so basically in 2020, in our conservative case, we're keeping things at around 55%, base case 57, and then optimistic case 59%. And unless there are major changes to the business, which is possible at a very mature business like Microsoft, you actually want to see margins stay relatively stable. I also do think actually by looking at this, these scenarios are a little bit potentially on the aggressive side, but if it did achieve 55% 2023, Street thinks it's 57% next year. There's no reason why, it can't necessarily maintain that level. But personally, might actually want to use the conservative case for this particular scenario. Everything else, I personally would use a base case so far. Okay, so let's go to our switch. Okay, I don't know why, but the computer is lagging a ton now. All right, so one down. Now let's go to Intelligent Cloud. Again, huge increase from 43% to 53% and looking like it will stay around here. Conservative base case, I'm going to keep it. I'm going to follow very, very consistent and similar basically, I'm going to do the same thing for all three scenarios for our EBIT, just because if we look at our Street estimates, they stay relatively stable. Like I think there won't be, like once it gets this high in terms of your EBIT margins, I just don't think that it's going to really grow that much more. So, okay. So Intelligent Cloud, conservative case. Let's do a similar thing, basically 3% decrease or increase. Okay, there we go. Okay, 52%. It's not really that much of a difference. May need to change this. So 51. Okay, actually, it's because we're rounding. 51.7, 53 versus 54.9. I think that's a good range. And in all likelihood, definitely things are not going to stay flat, right? Things change so much. Just look at the historicals. But by keeping it flat, one thing you do is you kind of incorporate both up case and down case scenarios. Or you implicitly are, you're not, because some years may be higher, some years may be lower, and it could average out, right? But if you were, if you wanted to really do things right, then you should have reasons to adjust the margins for as many years as you can. All right, so this more personal computing segment is interesting because it was higher and it's lower now in 2023 versus in the other segments, there's this huge jump. So if I had more time, what I would definitely look into is, what's causing margins to increase so much for Intelligent Cloud and productivity and business processes, but have it kind of go down for more personal computing. Probably some kind of like operational expenditure that they're maybe spending more on marketing or hiring more people. revenue growth has also slowed actually, so that's probably like part of it. But yeah, that's what I would look into that a little bit more. Seems like it's going to pick back up to 32% 2024 according to estimates, and maybe stay flat-ish around there. So I'm going to just keep it, I'm going to do the same thing, keep it around 32%. And let's do the same thing here. Decrease by, I actually don't like how I did this, 97%. I would go back, if I could go back, I would make this 3%, 3%, 3%, and then, or negative 3%. Here, let me just do it. Negative 3%, negative 3, negative 3. And then here, what I would do is like positive 3, positive 3, positive 3. And I'm going to need to change my formulas because everything's going to get messed up, or it is messed up now. So I'm getting the growth rate multiplying by 1 plus our rate, and this is negative 3%. And then this is multiplying by 1 plus our 3%. I'm going to have to do that here as well. Cool. So this times 1 plus our growth rate. And I would also probably change that for our revenue as well. I think it's just cleaner this way. Okay, as I wrap up this section, quick question also for you guys. What how often are you guys using ChatGPT for anything? Personally, I've been using ChatGPT a ton. Like almost every day if I'm like working on something. So this right now doesn't have a switch, but I'm going to build it. I just didn't want to, you know, scroll back all the way down and back up. Because my computer is being a little laggy. I am pretty curious to see what this all gets us to, because as I mentioned at the beginning of the video, our previous Microsoft DCF, the base case scenario had Microsoft, this is the old DCF, at $379 per share when it was trading at $250. And this was back in July 26, 2022. And currently today, Microsoft trades at $374, something like that. Yeah, $374. Which is pretty like, there was 51% upside based on our base case scenario, right? So I'm curious what this DCF is going to get us to. And we are kind of almost there. I'd say like maybe 30-ish minutes away. All right. So we have our EBIT, we have our revenue. That is the most time consuming part of this whole process. This is linking to the wrong cell. So this is saying that the EBIT margin for Microsoft will be around 47 to 50%. Okay, which is in line with, I think, what we had for our comps. Oh no, we had EBITDA margin, which is 50%, which is so our numbers are a little bit actually, no, it's okay. It should be fine. Okay. All right, time for the DCF. But now that I finished this section, let me answer some questions in the chat. By the way, I did see that some of you guys joined from like the Tesla DCF, the Google DCF stream a year ago. So thank you guys if you have been here since, you know, a year plus and are still watching these streams. Hopefully you still find them like engaging and interesting. I'm trying to see if there's any questions here. Did you take multiple corporate finance classes during your undergrad? During undergrad, I only took corporate finance and accounting was like a summer class that honestly I just crammed. Accounting, I think, is the most helpful course for banking for most like out of the business classes that most schools offer in undergrad. I would say accounting is like the most helpful. Corporate finance, I felt, had a lot of good introductory kind of topics here and there, but for banking in particular, for banking recruiting, I found a lot of things to be too theoretical and not very applicable. And also, I barely used anything I learned from corporate finance. I mean, you do learn about discount rates and stuff like that, and like cost of equity and those things. You definitely, and unlevering beta, levering beta. I think you know, obviously those are things that are relevant, but when it comes to corporate, for those classes, you don't learn about like valuation, which I think is probably like the most relevant thing for banking. Let's see what else there is. I see you guys use ChatGPT and Google Bard. Bard has current access to the internet. ChatGPT has been using Bing when I've been using it. See another one for Bard. How has your modeling changed over time? Anything you've added or removed to your process? Do you use these to support personal investment in individual stocks? Great question. The modeling over time, I think I don't actually do these revenue/EBIT builds that often. I think this might be the fifth video or so where I'm doing both a revenue and EBIT build. Maybe the second for both of these. I've done revenue builds like I think around 5 times. I would say also what I've changed, I'd say that in itself I think is a big change, doing revenue and EBIT. It's not like a ton of new stuff, honestly, but I would say that is one thing. The other thing, I think I've been adding like these trading comps, which is not necessarily about modeling, but it's not actually just like modeling. But I do think that, you know, we have been comparing our findings to like the comps and kind of double checking. So I think that's like a little bit of a new element, but I'd say in general, you know, to be frank, I don't think the concepts per se are like that different. I kind of keep doing these because, you know, I have done now like a lot of the tech companies twice, but Berkshire Hathaway I had never done before. I want to do some more additional companies I haven't done. And I think also the value of doing it for companies that I've already done is like there's new data and new information, right? So anything that I've streamed a year ago is like almost completely irrelevant now. So then even for like Microsoft, eventually, maybe like next year, I'll probably do another DCF for the company because it's of high interest to people and, you know, we'll have new fresh data. For individual investments, honestly, I'm pretty boring now. I just do like ETFs for crypto, just Bitcoin and Ethereum. I used to be pretty crazy with a lot of like individual stock picking and stuff like that. But right now, the investment I'm making is in my business. And what that means is just like putting in a lot of time and effort into this and not putting a lot of time and effort into making individual investments. Maybe in the future though, when I have some more time. But individual stock picking, I think, is just super, super hard. All right. Okay, so let's now get to our DCF, what we have been building towards this whole time. So we have our revenue, percent growth, EBIT, percent of sales, EBIT, DNA. Oh, I didn't collect the DNA information actually, or cash flow items. Gonna need to do that. Change in net working capital, percent of sales, or maybe percent of change in sales. We'll see. EBIT builds here, revenue builds here. So we have our income statement. We're also going to need to add cash flow. Okay, so as I do this kind of like more mindless linking, let me see if I can answer some of these questions. What does purple color code mean? It means you're linking to a cell in the same sheet. Green is to a different sheet. Evan says, I'd love to see a model to actual video where you compare your models to subsequent stock performance. Well, the thing is, let's, you know, like I showed you guys the DCF I built last time and how things, and that, and comparing that to how much things are, or to where Microsoft is now. But I would say that's kind of luck because Microsoft could be lower, much lower than it is now. It could be a lot higher, right? The fact that it's currently at where I modeled our base case to be, this was based off of really old assumptions. To make a video where, you know, these figures are compared to actual stock movement and all that, like it would require a lot of kind of daily monitoring, and I don't have time for that. Plus also, like, I don't think I'm really the best person to do something like that. You know, like I'm not a hedge fund investor or anything like with training for like fundamental stock investing, right? Okay, but anyway, what I'm doing right now is I am gathering historical data for our cash flow items. They're not going to be estimates. These are just going to all be historicals. total revenue. So we got percentage of sales. Then CapEx. I like to keep everything, all my numbers positive, meaning like this FactSet reports or just provides the negative numbers if it's negative, and then positive if it's positive. For me, and that makes sense because it's a cash flow statement, but for me, I like to just make everything positive, and then if it's something I need to subtract, then I'll actually just subtract it. All right, change in net working capital. Oh, I copied to the wrong row. But looks like but it looks pretty uneven. Also, if this is a cash inflow, so this one's negative. Change in net working capital is okay. Wait, something. Oh wait, I totally messed up something here. CapEx. What did I even pull from? Because this is definitely, yeah. I don't know why I just did this. Yeah, I should be pulling from the actual CapEx. I have no idea what I did there. Look at it later. Okay, so CapEx is here. Computer's so laggy. Okay. All right, that makes more sense. Change in net working capital. Looks like I'm just going to keep it at 0% because some years are 0 and some years -2. It's 2, like pretty much flat. Not going to really change our analysis much. Okay, so DNA, interestingly, around 7%, much lower than our CapEx, which is around 10 to 13%. So lots and lots of investments are being made. I think this would just have to be with like all the servers that they're, I think if they have servers, but I think I remember reading something about Microsoft developing its own chip as well, so that could be part of it. But I don't think it's going to really slow down anytime soon. But I do think that DNA will trend upwards over time, given the increase in CapEx. So anyway, let's start off with linking to our revenue. Then link to our EBIT. Oops, this says total revenue. I should say EBIT. Man, I never thought when I never would have thought that when I was, at my current age, basically 5 years after leaving banking, because I quit in 2018, that I would be like streaming models at like 11:30 p.m. or making models on my own volition. I used to have to do this for work. But actually, I still do find modeling pretty pretty interesting. Oh, I forgot about taxes. Where should I pull that? Okay, I guess we should pull it here. I actually don't think I even have this pulled in. I'm gonna have to find it. Nope. Okay, I'm gonna have to go into FactSet. Go to the historical income statement. Download. While I do that, see in the chat. Yes, Microsoft is looking at creating its own ARM-based chip. Okay, makes sense. What is smart precedence? That is FactSet. But you can get it for free if you use something called like Macabis or something like that. What kind of models do VC firms use for private companies? Yeah, that's interestingly enough, I just took a class about venture capital and the finance aspect of it for my MBA. And what I learned is that VCs don't really do a ton of valuation work. And that makes sense actually, because the companies are so young. Like, how can you properly model when they're like cash flow negative and all that? We built a DCF for our project and all that, but a lot of times it seems like VCs care a little bit more about like the terms of the deal and adjusting things here and there. They'll oftentimes look at like total TAM and what % of that total addressable market are you able to actually capture. They'll look at things like that and kind of triangulate to valuation. Okay, this was the income statement. What do we need here? Taxes, consolidated income taxes, 2017. I guess we should add pre-tax income. Here we go. Oh, Evan answered that very well. Yeah. TAM, CAC, customer acquisition cost, LTV, long-term value, I believe, of the customer. So like how much revenue can you generate from that particular customer on average from now until the end of time? And that's just, obviously you can't get that completely correct, but you can estimate that based on like historical information. Whoa, why is this tax so high? churn, like how quickly are customers leaving you. Burn rate. Actually, churn and burn rate sound kind of similar-ish. From VCs, from all the people I have met, it is more about understanding the business KPIs and having realistic expectations rather than modeling it, as the models most of the time are unreliable. Yep, I agree. I have no idea why taxes were so high in 2017. But I'm not going to worry about it. Sure, the company had its reasons. And so, but looks like tax rate 11% sometimes, 18%. Okay. Where does this leave us? Taxes, tax rate. All right. How much will Microsoft pay in taxes these next 5 years? Companies always do something weird. Like the corporate tax rate is 21% in the US, but this is their effective tax rate that, I don't know, maybe also includes international taxes. It's like blended. Okay, I'm definitely not going to sensitize for this because it's too late at night. But also just, I don't think we need to have like 3 different scenarios for our cash flow items. What I'm going to just do is take an average over the past 3 years, not 5, because there's another 11% in there and I want to be more on the conservative side. You always want to be a little bit more on the conservative side when you model because, or generally, at least that's my philosophy, because then you inherently build a larger margin of safety, essentially. For our DNA, I actually do think that we want to increase this over time because I think it'll get closer back to this 9%. I'm not really sure why it's so low here. I think what might be the scenario is that CapEx has been increasing and it's just taking some time for DNA to catch up for whatever reason, however they're doing their accounting. I think keeping CapEx around this, 10 to 11, 12% makes sense. DNA growing it back up to around 9% over time, I think is what we're gonna do. All right, so first, let's get our taxes. And get our tax rate. Then this. Oops. Hmm. 15%, pretty low. I guess I could sensitize on this, but just make it easier. I kind of don't love what it looks like right now. Let's just call this, so that if you by chance are, building this out and you feel like, oh, I feel like the tax rate shouldn't be, like, I want to be able to change it up a little bit at least. Let's make all of these into switches. Okay. And another thing I really don't like about how I built this assumptions thing is these like empty slots here. I would never do that in a real model, like at work. I will have to rethink about how I build these assumptions sections, and maybe I'll try to change that for a future stream. Not in love with the way it kind of looks right now, but I do think it does the job, right? And it's not like insanely hard to follow. Okay, so average tax rate past 3 years. That is our wait a minute, what am I doing here? Yeah, that is our base case, but it's pretty low. In our conservative case, let's call it our last year around 18%. And then in our optimistic scenario, I can't even imagine it goes that much lower. So let's just do the average of the past 5 years. I'd probably never use this scenario. Well, it should be slightly lower. Yeah, 14.3%. Okay. So what that means is what I'm going to do is the choose function, and I'm going to use the switch and then go to 3 values. Oops. Oh, it's so laggy. Oh, man. Okay, what's the other cell? V. Evans says, I use separate tabs for each scenario. Build mechanics for base scenario once. To copy and tweak all assumptions for the new scenario. Let me think about that. So use separate tabs for each scenario. Okay, so base, conservative, optimistic case have different tabs. Build mechanics for base scenario once. Then copy and tweak all assumptions for the new scenario. I don't know if I would want to have the different scenarios in different tabs though. It's kind of, I guess it if you had a summary tab that adds everything together or something like that. Which you probably do have. Okay. Interesting to see how other people do it. Evans, what do you do? Do you work in finance? Okay. DNA. Whoa. DNA is here. Corp Dev. What did you do? Did you do banking before? Or something finance related? Asking because you seem pretty knowledgeable, by the way. So nice to have you in the stream. Okay. Almost there. So we're going to treat these each DNA. I'm going to grow up. CapEx, I'm going to keep flat, but yeah, keep flat. Okay, yeah. All right, we're going to do these a little bit differently for each. For the base case scenario, I'm going to grow it up to 10%. Conservative case, grow it to 9%. Optimistic case, grow it to 11%. Okay, KQ, row 26. KQW26. Q26, W26. Is that plus the difference of that minus that divided by that minus your previous year. Okay, that works. This, by the way, is a pretty different way. I've not actually over the past streams moved DNA upwards and use the choose function with my last year. So this is actually a little bit different than what I normally do. But I'm doing this, so I'm growing up DNA because as I mentioned earlier, I think it's taking some time for DNA to catch up with CapEx. Normally you see DNA roughly be in line with CapEx, something around like 80-90% of CapEx over time. So I think right now it seems like, and I'm not 100% sure, but it seems like Microsoft is making very heavy investments and DNA has not yet caught up, but it will over time. That's my assumption. Okay. Next, in our base case scenario, take an average. Oh man, the stream is getting very long. It's been 200 hours. Okay, it's going to be like 3 hours. Past 5 years? Actually, let's do 3 years. So that is 12%. Optimistic scenario or conservative scenario, let's say 13%. And then for our conservative case, 11%. So equals choose. CapEx here. So K27, Q27, W27. I'm going to keep it flat. Make this red because it's kind of odd. All right. All right, CapEx, we're actually going to keep flat. So we're just make it 0 because it's like around 0 anyway. I guess to finish it all off, if we are being conservative, then maybe make this like 2%. Optimistic, maybe like negative 2%. And I think tech companies are the only ones that really can have like this negative net working capital. They somehow like just get money before they actually deliver the service. All right. So K28, Q28, W28. All right. Finally, we are at our unlevered free cash flow. Oops. Cash flow. Then we need our present value of unlevered free cash flow. So to get this, we get our EBIT plus our DNA minus our CapEx minus our change in net working capital. And now we need our WACC. So, oops. I'm going to take a bit of a shortcut and go get our WACC, what we did here for our last Microsoft DCF. Oh, shoot. Reminds me I should save. Okay. so let's see here. Market cap 2759.6. 2759600. So 2.8 trillion. We gotta fill this all out. The cost of debt we maybe need to keep. Okay. Risk-free rate is 10-year treasury yield. $4.193. Beta 0.98. So pretty much moves similarly with the stock market. Market risk premium. Damodaran. So this is a NYU professor who just publishes this. Implied equity risk premium, 4.53%. What did I have last time, just to check? 4.24, so it went up a bit. Cost of debt. Let's go to their filings. Seems like they have some debt trading, one at 3.125% and one at 2.625%. Okay, I know this is bad, but I'm going to take a shortcut and just call it, wait, let's see, how much is this? 2028, 2020, 2033. It's going to be such a small percentage. I would guess it'd be around 3%. Okay, debt. Let's get the figure. Short-term debt here, 25,808. So right now things are in millions. So this implies 25 billion in debt. I believe is correct. Yep. So 0.93%, basically nothing. Not going to affect our WACC. Our tax rate will link to whatever we're using in the model at the time. So actually let's use our base. 14.8%. Okay. Cost of debt is going to be around 3%. Interest expense. Okay, you could calculate it, but this is so small and insignificant. Just to be conservative, actually 2033. You want like something similar to this, right? So 3.2125. All right, I'm gonna be one little shortcut. I'm just gonna take an average. I know we probably shouldn't do that, but this is not gonna really affect our WACC anyway. 2.625. 2.625%. Okay, so our WACC is 8.58%. I think that's a little high, actually. All right, so conservative be a little bit higher, so let's say 0.5%. More conservative or optimistic, I would say is this minus 0.5%. And then pretty standard stuff. 1.5. 0.5. Actually, U.S. economy growth rate. Whoa. Average. Okay, U.S. What? GDP growth rate, average 3.2%. You can see here, the growth in the last model was 7.62%. Market risk premium went up, risk-free rate went up a ton. So yeah, let's actually make this 2.5%, 3%, 2%. Okay. All right, so now that we have our WACC, I think what the next thing we have to do is figure out our discount period, and then we are almost there. So this period, what did I call this? Oh, I didn't do mid count, mid-year discount period. Let me figure this out. So to explain what I'm going to be doing, which should look familiar if you have watched some of these streams before, is that when you discount by a year, you're assuming that you receive the cash flow at the end of one full year if your discount period's 1. But in reality, what we're looking at here for most companies is that you'll get your cash flow every day, right? As a company, it's not like you get all your cash at the end of 1 year. You might get it every month or whatever, but you're not going to get it at the end of each year, right? And so when it'll make more sense when I play around with the numbers later for you after it's all built. But if you just do like, okay, discount 1, that's +1, 6, then it doesn't really make sense because first of all, for this year's cash flow, you're actually only going to be taking the remaining amount for 2023, which is like 17 days worth of free cash flow, right? So what we want to do is figure out the percentage of the year we have left. Oh, this is not right. 2. There's always issues with this formula. I did it. Okay, let's see what I did in Berkshire. Oh, period discount period. That's what I called it. Okay. Year frac C5, C6. So I guess I just added a year end. Okay, so that's what we'll do. $12, $31, $23. This is C5 and C6. All right, so there's 0.052777 years left this year, right? So this is actually what we want to, so first of all, the amount of cash flow that we actually want for this year is this all multiplied by the amount of time we actually have left, which is that much time. So this is the actual cash flow that's coming in that we expect in the future, right? And your DCF is always going to be focused on your future free cash flows, not any past free cash flows, not even a penny. So that's why we only want to look for that amount for 2023. And just as like a small detailed nuance, this also, the inaccuracy with this is that we just got our total year's free cash flow and multiplied by a fraction, right? But what if Microsoft has huge Q4 sales and most of their sales comes in December, right? Then taking just a fraction based on the year isn't actually accurate. But for our purposes, like this is, we don't have the information to make a strong assumption either way. So okay, so then the next step is to figure out for a mid-year convention, what we're doing is we're making a very simple assumption that you get your cash flows in the middle of the year. So it's not really that advanced or complicated. We're just saying that instead of the end of the year, we're getting our cash flows in the middle. That kind of simplifies things, but evens things out a little bit because you're saying that you're not completely getting things at the end, but you're not getting it, all the way at the beginning either. So right now, this discount period is 0.53, right? And this is the number of, let's say 0.05. So this is the amount of time left in the year, but we want it in the middle of today and the end of the year. So you just simply divide this by 2. And that gets us to basically, we have 17 days of like 8 days later, December 21st, I guess. And then what we want to do next is figure out basically the middle of next year, which is June of 2024. So in order to do that, we're going to do n equals year frac C5, C6. This gets us to the end of 2023. What we're gonna do here is add 0.5 because that adds half a year, which is June 2024. So this gets us to 0.55. Then we just add a year. This gets us to June 2025, June 2026, 7, 8, etc. And we're gonna discount using these years instead of these years. And it actually makes a huge difference. So to get our present value free cash flow, get our free cash flow. Actually, this is a little bit different. What formula? or this, we're going to need to do something to get our WACC figure. So these are all our switches. Oh. Whoa. Okay. What I am doing here is I want to get an actual figure for our WACC and terminal growth rate. I don't want to incorporate the switch thing in the formula. I want to have an actual figure, so you guys will see what I mean. Okay, so WACC, we want to choose amongst these three options. Same thing for our terminal growth rate. Okay, and then I'm going to call this WACC. I'm going to call this TGR. Okay, so finally, get our free cash flow, divide by 1 plus our WACC, then to the power of the year or the discount period. That gets us multiply that. That gets us to our present value of free cash flow. Okay, so imagine I instead made this like 1 and made this plus 1. You can see our present value of free cash flow decreases like quite a bit. So that's why this actually makes a huge difference. All right, so now we get to our terminal value, present value of terminal value. Add that all up to get to our enterprise value. Add cash, subtract debt, gets us to our equity value. Then divide this by diluted shares. This gets us to our stock implied stock price, finally. All right, so terminal value, we get our last year's free cash flow times 1 plus our terminal growth rate, all divided by your WACC minus your terminal growth rate. The present value is that divided by 1 plus your WACC to the power of the last year you're projecting to. Enterprise value equals sum of your free cash flow, present value of free cash flow, present value, terminal value. Cash we don't have right now. So cash and cash equivalent short-term investments. Total cash blah 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 is 143,951. Debt. Okay, so our equity value is our enterprise value plus our cash minus our debt. Diluted share count is 7,528 million. All right, finally. So based on everything, our implied share count, implied stock price is 327.20. So right off the bat, our base case implies that actually, yeah, I think so. Microsoft's current share price, I think it's like 347. So it means that based on our analysis, it's a little bit overpriced, arguably. But of course, we'll have to take a look at what assumptions we decide to use. So, oh, it's 374. Okay, so even higher. 36. Applied share price. $327. So that implies 13% downside. Oh. Again, that's assuming that you decide to be just on our base case. Just out of curiosity, let's try making everything into our conservative case, see where we get. So our absolute lowest case scenario, conservative case, base case, optimistic case. So our conservative case is 221.17. Our base case is 327.2. Our optimistic case is 460.19. Yes, Cynthia, I am still here. Almost done though. We're talking about the price. So where does this leave us, and what personally do I think makes most sense given what we've gone through today? Let's go through each of our switches one by one, and I'll let you know what I kind of think right now. Yep, the previous WACC was a lot lower. So that was a huge driver and something we'll probably look at. So in terms of revenue, here, I think I would actually go with the optimistic case here. Intelligent growth, pretty low, 17. I think optimistic case actually, like I would say, or basically I would say between base and optimistic case for these two. And then I'd say it looks like base case looks more likely for between conservative and base case for these two for revenue. So what did I say? So basically 2 or 3, 1 or 2. EBIT. So pretty high. I would say base case here because it's already pretty, it's a big jump from 48% if you can maintain that. Same with intelligent cloud. I would say base case, more personal computing, base to optimistic. So base to optimistic. Taxes, DNA. What is DNA? 9%, 10%, 11%. Okay, so DNA, these I would just all keep as on the base case. WACC, this is a huge driver, and because interest rates have gone up, I think this is what's affecting valuation quite a bit. So 8.6% versus 8.1%, I would say I would either use our base or optimistic. But I do think Microsoft deserves to have a little bit of a lower WACC. I mean, it's the largest company in the world, right? So if you were to, I would probably argue for that. Whoa. So I would actually probably say WACC, I would use that. Terminal growth rate, there could be an argument to use the optimistic scenario. Okay, so where does this leave us? Let's say I'm gonna basically create my own low case scenario of what I expect, and then a high case scenario. All right, so based on the low case of what I think, as of now, based on the data we have today, so let's call this like my conservative case. Then to me, 354.3. And then if I use like let's call this my base case. My optimistic. If I were to use my optimistic case, I would say that. And so my implied share price is 375.91. So essentially, based on the model I built, I think Microsoft is pretty fully valued. I think the argument against this could be, look at what AI is doing. There's so much revenue potential. And just like when new technologies come out with things like the internet or the iPhone, the apps, the App Store and all that, you could argue that there's huge revenue potential for OpenAI and Microsoft as it implements all that technology into its products. But at the same time, maybe a lot of new technology new competitors come through, and then they just totally take the sales out of, or take the wind out of OpenAI and ChatGPT. Or, maybe like it's harder to monetize than expected when there are so many competing apps that are niche and specialized, right? Like right now, ChatGPT, I know like charges like $20 per month or something for a lot of users. I think actually with the ChatGPT app store or whatever it has, it's probably also making a lot of revenue. I'm sure there's tons of ways that the company will make money, but I also know that user engagement has kind of decreased over the past like few months. So there's a lot of uncertainty, even though Microsoft is very well positioned. I think even right now at 375, you know, I think there is always potential room up or down for any stock, right? Like obviously that's not very insightful, but to me, like I don't think Microsoft as of now has a ton of room to grow, at least from what I've built out here. And of course, like you could play around with the assumptions, make and change things up. I do think like, let's say Microsoft there was like a big impact to the stock for whatever reason, and it fell down, I don't know, to like 300 or something like that. I think then it could be like a very attractive stock, but you know, it has to actually go down for something like that. And that would mean a lot of these assumptions might change as well. But anyway, this is what I came out with. I hope you guys all found this helpful. Let me know if you guys have any last questions. I'm happy to answer. But as you guys write that out in the chat, I did want to give you guys a last friendly reminder. If you're interested in going even deeper into modeling, Wall Street Prep, they have this buy-side financial modeling course, and it's taught by a guy who worked at Maverick, DE Shaw, and Citadel, top hedge funds, and go through a lot of things like analyzing a business, going into if you look down here, actually like revenue builds, which is kind of what we did today, but it's in much more detail. Use my code RareLiquid to get 20% off. And so looking at the chat, toss up a sensitivity table for WACC and terminal growth rate. Man, honestly, I'm so tired. I'm going to have to sign off soon. Sorry. Cool. It seems like, could you maybe once talk about your portfolio? What are your holdings? I'm actually not investing a ton right now, so it wouldn't be that interesting. Mostly ETF stuff. And cool. So I think that's pretty much it. Thank you guys all for tuning in, especially if you somehow made it from beginning to end. And last question here. Sorry. Are those courses good for students in college? So I think it depends what your goals are. I think if you want to just learn and you're interested in finance, I would say so. I'm actually planning to take this course myself after I finish school, because right now I don't have enough time. Just because I feel like it'd be interesting to learn. If you want something a little bit more fundamental, they have this financial and valuation modeling package. And this is where you learn everything I learned in banking. So like financial statement modeling, DCFs, M&A, which is accretion dilution, trading comps, transaction comps, LBOs. You might want to start here if you don't have a lot of background information or knowledge. But with that said, thank you guys all for joining. Hope to catch you all in the next video. See you guys, and thank you for joining as always. Peace.